here's something that might get you excited about the U.S. and its markets heading into the July 4th holiday.
The Fed has a lot of ammunition in case anything goes wrong. The fiscal side, not as much, because, sovereign debt levels and the budget situation is an issue. But the Fed has a lot of room to cut, Chuck. And guess what? Remember quantitative easing? They haven't done that in a long time. If there's any problem, they can cut, and they can also start bond buying across the curve, and that will also offer stimulus to the economy. So, I'm not really worried about a recession at this juncture.
That's Jose Torres, senior economist at Interactive Brokers, and he believes that we will soon be through the tariff tantrums and that we can move on to policies that will help the U.S. thrive, and that the Fed will be cutting rates in short order to further that along. He's our big interview today, but up first, Todd Rosenbluth, head of research at VettaFi, is here with a dividend-oriented ETF of the week. And then Kyle Brown, Chief Executive Officer at Trinity Capital, is here talking about high-yield investing in the private credit markets.
Let's rock this joint!
Oh yeah, rocking your world since 2012. We are the original business and markets interview podcast. This is Money Life with me, Chuck Jaffe. Thank you so much for joining us. This is our show for July the 3rd, and we've got a great show planned and executed for you. And I think you're going to like what you hear from Jose Torres, but I think you have to also put things in perspective. We've been talking so much about the market and how it rebounded from April that what we haven't spent a lot of time is talking about how things have changed, because in April, you saw all the economists swing towards here comes recession, and the odds of recession went way up. Now you can kind of wager/invest on all of those things. Interactive Brokers, the firm that Jose Torres has what they call their forecast trader. You want to make a play on interest rates, you can do it. You want to make a play on recession, you can do it. Well, all these guys were saying, yeah, the odds of recession way up. Nobody's saying that now. You haven't heard anybody, as we've started to talk about second half outlooks and things along those lines, go, oh yeah, here comes the recession. That has not been what we've been hearing. And that's without resolution to tariffs, and that's without resolution to what's going on in Congress and what may or may not be happening with deficits and deficit spending, which is a big deal. There's a lot of stuff still to be resolved. But yeah, the overwhelming things we are getting tell us that things are relatively good. Now, that doesn't mean it's going to last forever. And I have a serious question to ask you guys. I'm always saying you should ask me questions, but I've got a serious question to ask you guys, because I have a chance to do an interview that would be focused on a lot of the forecasts of Martin Armstrong. It is not an interview with Martin Armstrong himself. It is an interview with a guy who's run a long-running podcast, who has now written a book based on some interviews he did with Martin Armstrong. And if you do not know who Martin Armstrong is, these days he runs a firm called Armstrong Economics. He developed something called the economic confidence model, which is an economic cycle theory that suggests that you've got waves occurring every 8.6 years. And there are different cycles. We've talked about them all the time. But the thing is that Martin Armstrong wound up with multiple violations of various rules, a criminal conviction, and some other sorts of things. And he's pretty much unrepentant. And so when I was offered this, look at this book that we've written and what have you, I thought this could be interesting. At the same time, I'm not somebody that hides blemishes and all, and I don't think most of the stuff here is going to cover the blemishes. So I'm thinking I'm passing on this one. This is a guy who, when he was getting in trouble and they were trying to make restitution, he purportedly hid a bunch of rare coins, did some things to make it that restitution couldn't be made. So I don't think he's a great guy, but I've never shied away from people who have various opinions. This is literally somebody where when he got out of prison, Bloomberg was writing about him, calling him the felon forecaster. And the oddity is, the criminal stuff was not about his forecasts. It was about other stuff he was doing. And I'll point out that, if you ever heard my show on WBIX radio in Boston, where Rob Floyd was my original producer, that station imploded because of a guy named Brad Blight, who ran a Ponzi scheme. He had actually bought the station at one point. He had a long-running Ponzi scheme where basically people who gave him their money in a way that he could access, he ripped them off. But people who gave him money in ways that, like, the checks were never made to an entity that he could crack the money in. So in other words, you paid it to an intermediary, like you made a check out to Schwab. He managed their money. And those people, when he was going off to jail, were like, but he's a great financial advisor. I made a ton of money with him. And it wasn't a Madoff situation where Bernie was doing complete make-believe accounting. Now, Brad Blight had make-believe accounting. That was for the people he was ripping off. But the people he actually served, he served well. And I wouldn't do an interview with him now, at least not about that stuff. And that's where you get with Martin Armstrong. It's like, okay, I can respect the fact that you have a proven track record that has shown some very interesting calls. Not all right, but nobody's all right. So, I sometimes ask you about things like, should we take this interview if somebody puts conditions on it or what have you? In this case, again, it's not an interview with Armstrong himself, but it's about a book that, truthfully, when I got the book, I was like, okay, interested to cover it, but I don't think we can cover it if we're not going to wind up getting into all of the trouble that the guy got into. And how does that impact, does it impact what you think about his economic forecasts? And if we can't go there, I don't think we can do the interview. But I'd love to know what you think, because I think it's an interesting story and maybe you want to hear more about it. Write me, chuck@moneylifeshow.com, and let me know who you do want to hear from, because we love getting the guests you're most interested in on the show. We've got a jobs report coming today. Frankly, I think people are expecting it to be somewhat weak after a different jobs report, not the official one, but it's something done by ADP, showed some job weakness yesterday. The ADP data, it's not a perfect predictor of what happens in the official data, but it's not altogether unreliable. So that has people on edge entering this. And that's likely going to have President Trump unhappy with this. If the numbers show up in a way that shows weakness, you can expect more pressure on Jerome Powell to cut. By the way, just a few days ago, the president tweeted truth, whatever you're going to call it, that Jerome Powell should be cutting rates not by 1%, which would be 100 basis points. And we have had folks now say that you might see 50 basis points, but nobody's predicting more than that. But no, to 1%. He said the rate should be 1% or lower. It'll be interesting to watch because, President Trump has talked about firing Jerome Powell, which technically he cannot do. But he's also talked about basically appointing Powell's replacement early, which would create a shadow Fed chairman. I don't think that's actually going to boost confidence in the economy or the dollar or the bond market. If anything, you might then find investors demanding a higher risk premium for owning treasuries. And by the way, even if you cut rates, if that happens, rates are going up. Like long-term interest rates would be rising. So we're in an interesting spot. It'll be fun to watch. But maybe the best news of all is as soon as we get through this day and we see whatever it's going to have, we get a couple days to digest and the weekend off. So I hope you have great things planned for the weekend. But first, you get through the great things we have planned for today. Again, Todd Rosenbluth, Kyle Brown, Jose Torres. We start things off with the ETF of the week next.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
One fund on point for today, the expert to talk about it. This is the ETF of the week. Welcome to the ETF of the week, where we examine trending, new, newsworthy, unique, and intriguing exchange-traded funds with Todd Rosenbluth, the head of research at VettaFi. At VettaFi.com, you'll find all the tools and research you need to be a savvy, smart investor in ETFs. Todd Rosenbluth, great to chat with you again.
Happy July 4th to be to you, Chuck.
Your ETF of the week is
The Alps Sector Dividend Dogs, SDOG, S-Dog.
S-Dog, Alps Sector Dividend Dogs.
Did that dog just say hi there?
That dog did just say hi there. Why is it saying hi there to us this week, Todd?
Listen, it's July 4th. We celebrate America. We celebrate American companies. I also, when I
think of America, you always hear about the underdog and rooting for the underdog. That's what S-Dog is. S-Dog is a collection of 50 large cap US stocks that have underperformed in the past year. So their dividend yield is the highest within their respective sector, is worth rooting for, is worth having within your portfolio, and getting a certainly very strong yield as well.
And the yield is a big part of it. I mean, this is a fund that last time I checked was yielding about 4%. You're talking about large cap value. At the same time, there are plenty of people who are worried about the status of dividend stocks. Our friends on Money Life from New Constructs recently did a whole bunch of stuff where they were looking at what they called fake dividends and false dividends and dividend traps. And the moral of the story was that there are a lot of dividend stocks that aren't quite what they're cracked up to be. You're leaning into that with this. So do you worry that, you're buying dogs hoping for good behavior, but that you might get bitten?
Well, you certainly might. Boy, that was a good one. I couldn't catch myself beforehand. You certainly could, but that's, again, the benefits of an ETF with 50 stocks and diversification. You're limiting the risk of a dividend cut. You're right. The yield is 4%. This is not a super dividend yield where the dividend yields are 8, 9, 10%, where the dividend is as likely to be at risk. I'd encourage the audience to take a closer look at what is inside the portfolio, look at the stocks, and what you'll find is 5 stocks across 10 different sectors. So every sector that you find within the marketplace, excluding real estate has its own dividend dog efforts. And so in technology, for example, you're finding Cisco and IBM. I'm not going to put on my stock hat and tell you that I have 100% confidence that the dividend is secure for each of those companies, but I think they're in pretty good shape based on what it is that I know. In financials, for example, you're going to get a company like KeyCorp. You certainly want to look at the holdings, but this is diversified, not only across the 50 stocks, but also, and 50, again, why not 50 with the 50 states? I didn't even plan on that one, but that's how it works also for it, but equally weighted. So each of the stocks is 2% of the portfolio at the time of the rebalance. There'll be some movement, so something might be 2.1 or 2.2 versus 1.8 or 1.9 here, but you're getting that diversification, so you're not risk of one company cutting their dividend and it having a disproportionately negative impact on your portfolio.
And this does give you some diversification. This is not like any of the picks that we've talked about where we're looking going, how much Mag 7 do they have, et cetera, because those are not the inhabitants here. And again, even if they were under equal weighting, they'd only be 2% of the portfolio. So that's the nice part about this. At the same time, I mean, when you talk about how somebody evaluates a fund, you turn to what people are going to see from Morningstar. There would be folks that would look at this and go, this is a 2-star fund. So you have to have some confidence. And by the way, it's not only a 2-star fund, it's a fund that as we record this, which is a little ahead of the July 4th holiday, it's below its 200-day moving average again. It's on the rise, and it may be there by the time this airs. But how do you get somebody over the hump of those things make me nervous?
So I'll look at the performance this year, and it's as we're recording this on June 23rd. I am going to say the date. We don't normally do that, but so we're far enough in advance. It's up 2.5%. That's in line with the broader market, I believe, but with an above average dividend yield. So you're buying this in part for the upside potential of those individual stocks and a reversion to the mean. Stocks that sold off might come back. These are large cap, relatively high quality companies that are among the 500 largest companies overall. This is a value play. This is not a growth at a reasonable price, but a value play where the dividend is competitive and exciting. This rebalances on an annual basis. So what is inside the portfolio today certainly is different than it was a year ago. And this is run by a VettaFi index. I'll disclose that, but that's not why I'm picking it. I'm picking it because it's providing you the diversification and can add on to a otherwise diversified portfolio, but giving you a higher income component.
And generally, do you like dividend dog strategies, which it's buy the highest yielding stock and rebalance periodically. There's the dogs of the Dow is what it's sort of famously known for. This is a twist on that. But have you been a fan of dividend dogs strategies over the long history that we've been able to now track them?
I love simplicity. I know a lot of this, some of the strategies we'll end up talking about are not simple, but this is simple and it works. It historically has worked. You're right. It's based on the dogs of the Dow theory that many years ago, when I was a financial advisor, I remember learning about and being educated about the merits of that reversion to the mean. That's what this is based on, but you get the broader diversification across sectors. So it's equally weighted at the stock level. It's equally weighted at the sector level. You talked about Mag 7 earlier. This is only 10% technology. It's 10% utilities also. So you're balancing that out. I think this is a simple strategy that has worked over time. And I think it's worth people taking a closer look at as they're celebrating America and celebrating American companies.
It won't necessarily lead to fireworks in your portfolio, but you also aren't likely to get burned by it. It's the ALPS Sector Dividend Dogs ETF, ticker SDOG, the ETF of the week from Todd Rosenbluth at VettaFi. Todd, great stuff as always. Happy holidays. We'll talk to you again next week.
Happy holidays to you and to your dog that is sometimes behind us when we're doing these conversations.
Yes, not today, but we love it when he's here. Todd Rosenbluth is head of research at VettaFi. Go to VettaFi.com for more information and to dig into the ETFs we talk about here or whatever ETFs you want to research from your own portfolio. And of course, Todd kicks us off every Thursday here on Money Life, and we are just getting started. Later, our big interview will feature Jose Torres, senior economist at Interactive Brokers. But up next, it's The Navigator with Kyle Brown, chief executive officer at Trinity Capital. Stick around. This is Money Life.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Kyle Brown, chief executive officer at Trinity Capital, is here. We're talking high yields in private credit markets now on The Navigator. Welcome to The Navigator, where we talk about all-weather active investing and plotting a course to financial success with the help of closed-end funds. The Navigator is brought to you by the Active Investment Company Alliance, a unique industry organization representing the full spectrum of the closed-end fund business, from investors and users to fund sponsors and creators. If you're looking for excellence beyond indexing, the Navigator will point you in the right direction. And today we're looking into the private credit industry, and we're doing it with Kyle Brown, Chief Executive Officer at Trinity Capital, a business development company that trades on the NASDAQ under the ticker symbol TRIN. And you can learn about the firm at trinitycapital.com. And if you're hunting for more information generally about BDCs, but also on closed-end funds and interval funds, go to AICalliance.org. That's the website for the Active Investment Company Alliance. Kyle Brown, welcome back to The Navigator.
Good to see you, Chuck. Thanks for having me.
We last spoke with you in 2022, and one of the things that has happened big time since then is not just that the market took off, but in 2022, you guys were providing high yields at a time when the market was not doing well. And the result of that was that it kind of turbocharged growth for what we've seen in 23 and 24. So in other words, when the market did better, well, venture-backed growth still had a tremendous amount of interest. So help us understand where Trinity Capital is at now and how that growth has played into what's been going on for you.
You bet. And I think it's a general kind of trend across private credit, really. Continued growth of the private sector, banks shifting from lending directly to companies to lending to private credit firms, giving the private credit market the ability to continue that growth. And we really have benefited from that. We've been able to, since we talked last, we've doubled the size of our business. We are deploying north of $1.5 billion to $2 billion a year now in capital to rapidly growing companies that are sponsor backed, either late stage venture capital backed, kind of pre-IPO, into the lower middle market, private equity sponsored companies that are 3 to 50 million of EBITDA, but really, like you said, focused on growth where our capital is going towards marketing, sales, building the business for companies that are doing well despite what's going on from a macro sense. So the markets continue to grow. I think what we've seen over the last really 5 to 10 years is that private markets are here to stay. Public companies have continued to decline in their number, and the private market during that time frame has continued to grow, which creates a really a new need for capital, and that we've been able to fulfill. So our business has experienced growth while maintaining that strong dividend and return for investors. We've not seen dilution happen there for our investors. So dividends have continued either consistent or growing over the last 23 quarters. And so our growth has not come at the detriment to investors. We've been able to keep returns really steady during that season of growth.
Consistent dividends and some measure of certainty is what investors really want. And in private credit, obviously, we are dealing with things where the investors are counting on you guys to do all the heavy lifting because they can't see what's going on. It's not like they can be watching the public companies and doing it. There's a lot of covenants that are in these deals that are really important to them. And what that means is that they're also, and you guys are also looking for some measure of certainty. So we're in a market where, although things have rebounded from April, et cetera, there's still a lot of uncertainty. And one of the key areas I would think would be where private credit should shine, which is if we're going to have nearshoring, we're going to have companies spending a lot of money on capital expenditures. And if they're doing that, they're going to need to finance that. So how do you balance that need, and have you seen the demand there, with the idea that there is a lot of geopolitical uncertainty that could change that all up pretty quickly?
Yeah, you're actually hitting on something that we've seen a lot of recently. So equipment financing is a big part of what we do, providing mission critical equipment financing to cover CapEx needs for companies that manufacture and develop something here in the US. And since the beginning of the year, we've seen a over 20% increase in demand for CapEx spend for companies manufacturing here in the US. And so we are heavily focused on that right now. That's probably one of our largest drivers right now of growth is equipment financing for US based manufacturing. It's really not specific to any one industry. It's really kind of across the board. We've seen increased demand for CapEx spend. So that's actually how we cut our teeth back in 2008 was equipment financing for the lower middle market. We've leaned back into that in a big way right now. And actually we love that business as well because our loss rate historically has been under 22 basis points annually. When you factor in realized gains, we actually have a negative loss rate. So it's a great business for us. We're uniquely positioned to support that lower middle market and late stage VC companies with that CapEx spend. So yeah, that's a big and growing demand right now in the US is CapEx spend for companies manufacturing here.
I'm curious about that because the good news is when I hear you talk about that increased demand, I'm going, okay, well, that's actually seeing what the politicians who said, hey, if we do this, that'll be the result. That's actually getting some delivery on what we expected there. The flip side of that would be the potential for maybe a little bit more default. You've got companies that are facing a challenge. They weren't necessarily planning on doing this. They're kind of being pushed into doing this by policies. Because you mentioned how low the default rate is, how limited the losses have been, but how much do you worry that given these conditions, we might see increased losses, at least in the industry? Obviously, you're going to try to avoid them. Everybody's going to, but how much do you worry that we might also be pushing to where some of that push creates more defaults?
Well, I'll just tell you how we think about and how we underwrite. When we're underwriting and financing this equipment, we're thinking about it in two ways. One, it has to be mission critical. It has to be, the company cannot survive without it. They have to make a product with it, right? It has to be off the shelf. It cannot be specialized equipment. So this has to be equipment that can be utilized in other industries for other companies doing other things. All of our facilities on the equipment side are primarily fully amortizing. So we're getting repaid over a 24 to 36 month time period. So we're getting our principal paid down right out of the gate. So that combination of real value in the equipment. So if the company doesn't survive or they can't get to scale, we still have a piece of hard equipment that we can go pick up, we can go sell in the secondary market. That combined with the fully amortizing payments that we're getting out of the gate. And when we underwrite, these companies have a couple of years of cash life. So we typically get off risk, and that just means we've gotten our principal back within 2 years. So we underwrite in such a way where we can get the combination of that real liquidity value of the equipment combined with the fully amortizing payments we receive. We're off risk within 2 years, and then everything after that's gravy, right? That's additional return. So what you're saying that may exist, the way in our world it does not because of how we underwrite, and that's how we mitigate lending to kind of growth-oriented businesses. We don't want specific equipment they can't go off and sell on the secondary market. We make sure we have that real value there.
What has been the impact on higher interest rates for longer as it relates to you guys and your activities? I mean, Trinity Capital has a dividend yield that's about 14.5% last time I checked. And you guys have talked about being consistently in the double digits. That's part of what you want to be doing. But what is the interest rate environment doing, both in terms of your yield and also what you see happening broadly on the industry?
Well, first off, I'll tell you, I don't actually want it to be a 14% dividend yield. We were BDC. We're an internally managed BDC. We have to pay out 90+% of our income to investors. We make too much income, and so we have to pay that out. The yield being high is a product of the stock being too low. I'm happy to say that out loud. I buy the stock with my own money all the time because I believe that. So that is why the yield is so high. We are still a newer public company. We're 5 years in, publicly reporting. We're trading 20 to 50% below our internally managed BDC peers. And I think over time that we'll move towards that median value. So I think with regards to the stock, I think that, it's great income, but there's actually a ton of upside in just the stock price as well as we move towards more of an average between our peers. The consistent income nature of our business, we generate current income. So when we're lending, we've got over 100 borrowers. We don't have any PIK income. This is all current pay. We're generating anywhere from 11 to 14% yields on our underlying investments from our borrowers. And the rate impacts have been interesting, even with rate cuts. What we have that's very different than almost all of the BDCs is we have floor rates across the majority of our portfolio. So let's say rates get cut further from here. We currently the majority of our portfolio is at its floor rates. So a decrease of, say, another 100 basis points, Fed cut rates, would actually, there's a possible scenario here where we have a positive outcome for our portfolio because the cost of Trinity's debt will go down, but the portfolio yields will not. So we have seen some decrease in net income because of rate cuts, but we've hit a point now where further rate cuts have little to no impact. In fact, maybe a positive impact to our net income because the cost of our debt capital will go down. So, rate increases had some impact on our portfolio, but we sit at such a low loan to value compared to the middle market or upper middle market. When we lend to companies, we sit at 10 to 20% loan to value. And so an increased cost of the debt facility, it's not a make or break for these companies. A decrease has, hurt all BDCs from the net income standpoint. But for us, it's actually created an interesting scenario going forward. The government or the president is pushing significantly for rate cuts. And if that does happen, we could see some really interesting benefits to Trinity. So we'll see what happens.
Expound on that a little bit further. The benefits to Trinity, if we see rate cuts, would be more activity?
Well, so we've got a $500 million line of credit led by KeyBank in a syndicate of banks. That's floating rate, right? So if rates go down, the cost of our leverage will go down. Our underlying loans to our over 100 borrowers are either fixed because they're equipment financings or they're floating rates, but they have floor rates, meaning we're not just going to see our net income continue to dwindle down as rate cuts happen. We have floor rates that create a foundation, a basis for what the cost of that facility is. And even if rates get cut another 100, 200 basis points, our loans don't change with our borrowers. That's why we could see some benefit there across the portfolio.
And in terms of what you see going forward, I mean, the economy seems to be in a spot where, although people worry about what might happen with the market, recession risks and all that other sort of stuff seem to be very minimal. So for you, if you're not worried about those things, is that pretty clear sailing? Like, I would imagine in the private credit market that when recession is looming, those are the scary times. These times shouldn't be scary, are they?
We have operated this business successfully through 5 administrations. We have seen multiple ups and downs from a macro sense since the great financial crisis. There were 4,000 public companies then. There are over 8,000 public companies back then. There are under 4,000 public companies today. The private credit market has grown. Regulations have made it more difficult for banks to lend money directly to companies. This isn't going anywhere. This is only growing. In some ways, it's just beginning and becoming more and more robust. So I think that we underwrite in such a way where we're able to get off risk quickly. And the majority of our portfolio has already turned over from 3 years ago. So we don't have long-standing credits that are just kind of dwindling in the portfolio. We're continuing to underwrite and make new investments based on what's going on today. And so, I would tell you, we constantly have our eye on the ball, trying to understand what the impacts of tariffs, the impacts of rates, the reshoring of manufacturing to the US, how that impacts customers, how that impacts their cost of goods, et cetera. We think about all these things, of course, but I think the business model stands regardless of what's going on. And, Trinity Capital has proven through multiple administrations and multiple cycles that we can be profitable. We can shift, we can ebb, we can flow, and end up on top. And so I'm confident that regardless of what happens, and I'm sure something will, we'll figure out a way to keep our eye on the ball and deliver great returns for investors.
We will be watching what happens, and I'm sure we will touch base with you again. Meanwhile, thank you so much for taking a little time out of paradise on a family trip to join us here on The Navigator. Enjoy the holiday. We'll talk to you again down the line.
Thanks, Chuck.
Kyle Brown is Chief Executive Officer at Trinity Capital. That's a business development company that trades under the ticker symbol TRIN. Learn more about the company and everything it does at trinitycapital.com. Up next on the July 3rd edition of Money Life, Jose Torres, Senior Economist at Interactive Brokers, is here for the big interview. Think of it as more fireworks for your financial mind. And keep it right here. This is Money Life. It's time for the big interview on the July 3rd edition of Money Life. Returning to the show today, Jose Torres. He is Senior Economist at Interactive Brokers. It's interactivebrokers.com, but I'll also point out that one of the things that Interactive Brokers has been developing is their forecast trader. When you talk with economists and you're looking at things, you're looking at forecasts. Well, if you want to learn more about Forecast Trader, we've got a direct link to that where you find Jose on our guest page and in our show notes as well. Jose Torres, it's great to have you back on Money Life.
Chuck Jaffe, great to be here. Thanks so much for having me.
Let's start with your base case on where we are, because we've just finished the first half of the year. And truthfully, if we had closed our eyes, looked at things 6 months ago, and then we just opened them this week, we would kind of go, yeah, what we got was what I expected. But of course, the ride was very different. So as you are looking at things now, how much is your forecast for the second half of the year the same as it was 6 months ago? How much has it changed?
Well, Chuck, it's become increasingly bullish because it looks like a lot of the trade deals are going to go in the way of the U.S., and that's going to offer manufacturing progress in terms of onshoring, in terms of capital investments, as well as hiring. Also, once we get past a lot of these trade agreements, I'm expecting an EU deal, an India deal to be closed. July 2nd, we got a deal with Vietnam. We do have somewhat of an understanding with China. We have a deal with UK. Soon, Chuck, 60% of the world GDP, including the US, will be under a trade deal, which means that cross-border commerce discussions are going to be in the rearview mirror for the most part. And then the market is going to increasingly focus on the more positive aspects of the Trump policy mix, because tariffs, that was the huge negative of the Trump policy mix. Now we're going to start focusing on lighter taxation, milder regulations, subdued energy costs, and rising factory production in the US, and hopefully rising employment as well.
That would be a win on a lot of different fronts. Will we get to those positives without feeling significant impact of whatever we settle on tariffs? Because we haven't seen a lot of tariff driven inflation, but depending on who you believe, we might. So are you in the camp that says, yeah, that's still coming, or are we past that?
Chuck, I don't think we're going to see much tariff inflation. Most levies on imports are going to be between 10 and 20%. The only nation that I think we're going to maintain an increasingly adversarial posture against is going to be China, where the duty is going to be roughly 50% or 55%. So when you consider also that year after year, decade after decade, goods, excluding the pandemic era, goods has become less and less significant in terms of its share of the US economy. It's become more and more services. Then you don't have as much of an influence from physical products to be able to drive inflationary pressures north. And then the Trump administration has also been focusing on oil production so that those subdued energy costs serve as a hedge on the potential for physical product inflation to begin to flare up. And services, those are labor intensive. We are seeing some kind of wage inflation still remain, but immigration restrictiveness could drive that a little higher, albeit that'll be countered somewhat by shelter disinflation because immigration restrictiveness is somewhat of a disinflationary force from a housing perspective, but an inflationary force from a wage perspective. But overall, the last PCE readings in the low twos. I think the Fed here is in the mid fours. I think they're too tight. I think they got a cut here in July. Right now, our IBKR forecast trader tool offers roughly 25% odds that the Fed's going to dish out a quarter point trim this month. Chuck, if the Fed cuts 25, they're still in the fours and inflation is still in the twos. So I think we need to get a rate cut here.
Considering the potential for a rate cut, let's go back. You said the IBKR forecast trader says 25% odds of a rate cut. What do you say are the chances of the rate cut? I mean, you've said you think the Fed should do it, but you also understand economically why they are not. And you understand the pressure that might be brought to bear and what it could do if President Trump decides that he wants to create a shadow Fed chair, which there's a lot of talk about. So I understand what the forecasters are saying, but if you had to be trading on Forecast Trader, you taking that up? Yeah, quarter point or a half point in July rather than waiting till September?
Yeah, I think the yes is undervalued at roughly 25 cents. I think that should be roughly 33 cents, roughly 1 in 3 chances, 1 in 3, 33% odds. And really what's driving me more to the yes side in July, we haven't got the non-farm payrolls report. That's on July 3rd. We're taping this on July 2nd. But this morning, Chuck, we got the worst ADP jobs report in 27 months. The first month of job losses in the private sector during that time period. So the Fed has had dual mandate of stable prices and strong labor conditions, but they've been prioritizing labor conditions more than inflation when we look at the 2023 and 2024 periods. In fact, last year, you saw during the summer when job growth began to descend below 100,000, the Fed came out in September and enacted a supersized 50 basis point jumbo rate reduction. So now we're starting to get into a position where I think several data points are saying that labor markets are beginning to decelerate, and that can motivate a trim here as well. If they don't go in July, I think September is almost a sure shot. Albeit, if tomorrow, July 3rd's non-farm payrolls is a blockbuster number, then that brings the odds down in my mind from 33% down to 18%, call it, or 17%. And then forecast traders will probably dial down their odds from 25%, maybe to 15% or 10% or something like that.
Here we are talking about rate cuts, but what we've moved away from is any potential for recession. It's not really in anybody's forecast at this point. When does it come back into the picture for you?
When you look at what's ahead of us, the traditional GOP playbook of reduced taxation and milder regulations and what that does to animal spirits, it's really tough to see a recession anytime soon. In fact, since the great financial crisis, central banks and fiscal authorities, not just in the US, but all around the world, have been extremely proactive in putting out fires and just really adding liquidity and providing stimulus from either the monetary or fiscal side ASAP as soon as there's any sign of trouble. So recessions are, much less frequent. They're not as often as they used to be. Um, but the cost of that, Chuck, of not accepting that economic volatility as policymakers, the cost of that is subdued growth over the long run, right? Because if by intervening in markets like that and the economy and the fiscal and monetary side, then it also does limit its growth. A much longer discussion, much more of an academic kind of discussion. But the point here is that the Fed has a lot of ammunition in cases anything goes wrong. The fiscal side, not as much because, sovereign debt levels and the budget situation is an issue. But the Fed has a lot of room to cut, Chuck. And guess what? Remember quantitative easing? They haven't done that in a long time. If there's any problem, they can cut, and they can also start bond buying across the curve, and that will also offer stimulus to the economy. So, I'm not really worried about a recession at this juncture. As far as tariffs and their potential to create a slowdown, during Trump 1.0, we saw that the adversarial posture against China didn't result in much inflation, didn't result in much economic weakness at all. In fact, some quarters we actually grew north of 4%. So that really, informs the bullish outlook. Finally, last point, government spending reductions. That could have been a recession sparker. Austerity measures, when you look at them from a historical standpoint, they are terrible for short-term economic performance, and they're awful for risk assets. We had the Department of Government Efficiency led by Elon Musk. There were a lot of declarations made early of the US saving trillions of dollars. Well, Chuck, when it was time to make the tough choices, I told CNBC on January 1st, way before all this, President Trump is not a fiscal hawk. He's more of a man of the people, he's more of a conservative kind of populist. He wants to give the folks what they want, what they need, which, is essentially fiscal spending and monetary stimulus. So, for that reason, that was a big risk, the government spending reductions and the potential impact it would have on labor markets and consumer spending. We're not going to get any of that. It looks like the taxation package that's in the House of Representatives today on July 2nd doesn't make those significant spending cuts. In fact, many of the hardliners, Freedom Caucus members, traditional Tea Party guys and gals, they're really upset that the budget deficit is going to remain wide.
Well, let's talk about that budget deficit remaining wide, because we're kind of kicking the can down the road a little bit further when it comes to those sorts of things. And there does come a point where this shows up in markets and how others will buy our bonds and whatever. And no matter what anyone wants to say about tariffs, the thing that we export more of and better of than anybody else in the world is our debt. We export our bonds like crazy, and we have changed market sentiment. We've also seen, talked about very widely, but very briefly, reduction in the credit rating, et cetera. How much are you worried that, great, we can continue and, we want to make hay while the sun shines, but that there are some long-term storm clouds building if something doesn't happen with the debt?
Well, absolutely, Chuck. I think that there's risks that are more down the line, medium to long term. And really, the major concern here is that the cost of duration is going to go through the roof. And we've seen since the pandemic, the manufacturing sector globally, the real estate sector globally, just can't survive with this kind of cost at the long end of the curve. When mortgage rates north of 6%, 7%, right now they're roughly, July 2nd, they're roughly 6.6%. Transactions can't get done. And manufacturing, similar dynamic. Transactions, orders, revenues, you can't make the numbers because the financing charges are too heavy. And that's ultimately the risk long term, that those interest rate sensitive sectors aren't going to be able to perform as well. And they're important segments of the economy. Manufacturing and real estate is roughly a quarter to a third of the US economy. So when you don't have those elements of the landscape contributing positively, then you essentially become more of a one-trick pony. You're depending on services employment and services spending to drive the economy north, and that's what we've been doing for quite some time. So that gives us a more shallow profile in terms of economic characteristics. And we'd like to be more spread out, more diversified, where we have everything working well. So I think that's a big issue with long-term rates going higher, and that being a consequence of sovereign debt loads continuing to build. Now, an offsetting factor, however, is that similar to currency markets, fixed income markets are also very relative, and sovereign debt loads, we haven't been the only ones that have been living way beyond their means. Almost every other country has as well, especially the developed ones when you consider the EU, when you consider China, when you consider a lot of the emerging countries. A lot of folks are working budget deficits. So then it becomes a story of what kind of debt do investors want to own? And then finally, are central banks going to pick up a lot of that debt, like in Japan, where, here the Fed owns roughly 22% or 23% of the treasuries in the float. In Japan, that's up to 50%. So there are ways to control those long-term interest rates, but by doing that and by minimizing the economic volatility, that does subdue growth. So I'm worried about it in the long run. I wish that the tariff revenues and the tax revenues from the economic growth are going to be so terrific that that's going to be able to bring the deficit down. But the numbers are just so staggering, Chuck, that it's tough to ever envision us going back to a surplus like we did during the last year of the Clinton administration.
Yeah, I don't know that there's any way that ever happens again. I do know that investors have been rewarded for looking internationally, even as the tariff news was breaking through the early parts of this year. What is your take right now on the international economies? Because, we always say if the U.S. gets the sniffles, everybody else gets a cold. Well, right now things here are pretty good and we're coming through it pretty well, but they're on the other end of those tariffs and what have you. So how are you looking at international economies and markets right now?
Valuations are a lot more attractive. Part of that move, there was an incremental move away from the US. President Trump was being quite turbulent in his character and his messaging and his declarations. Folks got really scared. There was when he first won the election and took the Oval Office, there was significant nationalistic sentiments. So that made other countries not want to invest as much in US assets. So they started picking up assets in other countries. And it seemed, US markets did great. We were running hot. And it seemed like a prudent thing to want to diversify geographically. Turns out it was the way to outperform because those markets are EU, UK, Asia, et cetera. Those major markets, major equity benchmarks are up north of 15% year to date, when the US is up roughly 5 to 7%. So that's been part of the story. And I think that because those valuations are so low, I think that there's more space for European equities to continue to outperform America because our metrics here on price to earnings, price to cash flow, those valuation equations, they're really stretched at the moment. And part of the reason why that is because we're the most accessible and we have the best, fastest growing companies. But of course, there is a price to everything. And the EU has great companies too. So I think the EU is a great place to invest in terms of international areas. I think that the deal that is going to close soon, I'm speculating here, I think the deal is going to close soon between the EU and the US is going to be great for the EU. I think we're going to be talking about just 10% tariffs on EU imports to the US. And I think that's going to strengthen ties with the West, and the Western powers are going to come together. Hopefully, Canada and Mexico think we can work out things with them, and both economies will benefit significantly. But we will have somewhat of a regionalization kind of play there because, Beijing is really upset that the U.S. is trying to maximize its influence in terms of goods production. Because, Chuck, what turned China from a poor country to a middle income one has been manufacturing prowess, has been their ability to produce goods and export them to other parts of the world at lower prices. Now that the US is trying to step in there, that's really threatening the nation's influence and really messing with what's been their reliable sector and their reliable practices. They've been trying to become the number one economy in the world. That path, since President Trump's first term, has narrowed considerably. They've had the ambitious 5% annual target I remember back in 2014, 2013, everyone was saying that, oh, it's only a matter of time before China's becomes the number one economy. But that rapid growth from back then, Chuck, it's not happening anymore. And they've been having weak conditions for a long time when you look at their manufacturing exports and when we look at their real estate sector, which is highly levered, and the households in that nation depend a lot on, and they're just not having any slack of air. And it doesn't look like prospects are going to improve anytime soon.
As for prospects improving and all the rest, does any of this change, to accomplish some of the goals that the president was hoping for, we needed the dollar to get significantly weaker. It has gotten weaker, but depending on who you talk to, it needs to get weaker still to actually achieve certain things. Is there an impact there? Is there a point where we've weakened the dollar too much and there's a price to pay for that? Or is it the other way? There's only so far we can go, and therefore we can only get to a certain level in the results that they're trying to achieve.
Yeah, I think that we can go lower and it be a positive for the nation on balance. The problem with a lower dollar, of course, is that imports become more expensive. But with what I said earlier on goods meaning less to the overall economy as well to the overall inflation picture, I'm not really worried that a weaker dollar is going to reignite goods inflation that much. In fact, I think that a weaker dollar will help the administration in its manufacturing onshoring ambitions and make our exports cheaper for other nations to buy. So I'd rather be on the latter case rather than the former. You get a few Fed rate cuts, you get the long end of the curve coming in a little bit. Today on July 2nd, we're seeing the long end of the curve rise because of what's happening in UK. In the UK, early, to the point earlier about sovereign debt loads not being a problem that's just domestic, a global phenomenon. And despite July 2nd's ADP report coming in way below projections and a big negative 33,000, it's so odd that the long end of the curve is actually going higher and not lower. But another important thing with interest rates, we've seen that at some elevated levels on the 2-year yield, that level is 4%. On the 10-year yield, that level is 4.50. On the 30-year, that level is 5%. We really see fixed income players come in there and bond vigilantes and turn into buyers defending those levels. A 10-year shouldn't be at 4.50 with inflation in the low twos. Just doesn't make sense.
Jose, I've got more questions. I just don't have more time. So we'll have to reconvene this down the line as we watch how things play out. The good news is that if you're right, things will be pretty benign, and then we'll see how they're shaping up as we get a chance to do this again. Thanks, as always, for coming on Money Life.
Thanks for having me, Chuck. Looking forward to next time.
That's Jose Torres. He's senior economist at Interactive Brokers. It's interactivebrokers.com. But again, if you want to go directly to the forecast trader to see what the forecasts are and then what the trading action is on them, we have a link directly to that as well for Forecast Trader at Interactive Brokers. And we will be back to put a bow on this show and this week on Money Life because, of course, we're off for the holiday, but we'll set you up for next week so that you go away to the holiday happy. Stick around, the finish line's in sight, and we'll cross it together momentarily.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
We are back to wrap this one up. And of course, this ends our week in terms of shows because we're not going to be doing a show for July 4th. Basically, we're here every day that the market is open, but the market is taking the holiday, so we're going to take one too. But we've got great things planned for you next week, starting on Monday. Christopher Zook from Kaz Investments will be here. He's a long-term thematic investor who does growth at a reasonable price. And so we'll talk about how he mixes those things. He'll be our market call on Monday. We've also got David Traynor, and he's got an interesting thing coming. When we talked about it, I said, okay, well, this is kind of going to be another two-parter. But that's because, and he wasn't planning on that. He sort of said, hey, here's what we're going to do. And I said, great. But then you got to follow that up. So what it actually means is that you're going to get a dangerous pick coming on Monday a really interesting, dangerous pick. And then the following Monday, you're going to get the opposite. You're going to get a bullish pick, which he doesn't do very often. But also coming on Monday, Nick Majuli. He is Chief Operating Officer at Ritholtz Wealth Management. He's got a new book coming out, which we'll talk with him about later this month. We'll have copies to give away as well. But he's here talking about the market and everything else. He runs the Of Dollars and Data blog, and he's one of the best bloggers out there. So he's coming next week on Monday. Tuesday, Rob Williams, Chief Investment Strategist at Sage Advisory Services. Wednesday, Brendan Ahern, the Chief Investment Officer at Crane Shares, back on the show for the first time in a couple of years, one of the leading investors in China in terms of running mutual funds that do not just emerging markets, but specifically China. Going to be very interesting conversation there. John Silva, Founder and Chief Executive Officer at Dynamic Economic Strategy. He will be here on July the 10th. And I'm excited for that because that is our first discussion with him. But we've got other things coming later this month, including Ben Cook, the portfolio manager for the Hennessy BP Energy Fund. Nanette Abahoff-Jacobson, global investment strategist at the Hartford Funds, returns to the show. Matt Miskin, co-chief investment strategist at John Hancock, is coming back. That he had to reschedule, but we've got that rescheduled. Natalie Trevithick, head of investment-grade corporate bonds for Payden and Regal. Scott Ladner, chief investment officer for Horizon Investments. They're all coming. And by the way, before another month has passed, we'll also have Daryl Cronk, Chief Investment Officer for Wells Fargo Wealth and Investment Management. And that's just big interviews, and that's just some of them. But we also have Garvin Jabush, Chief Investment Officer for Green Alpha Advisors, coming back to the market call. Bill Davis from Stance Capital. James Abate from Center Asset Management. And talking technicals, Vincent Randazzo, Chief Market Strategist at ViewRight Advisors, makes his debut on the show next week. Mark Newton, Global Head of Technical Strategy for Fundstrat Global Advisors, will be here in 2 weeks. Jeff Crumpleman, we got that rescheduled. He'll also be here by the middle of the month. So great things coming. Plan to be here with us each and every day, or to take us with you and use things like the holiday to catch up. Meanwhile, if you are looking for something to celebrate today ahead of July 4th, it's American Redneck Day. Do we really want to celebrate that? Maybe. It's Disobedience Day. I guess you have the disobedience before you get to July 4th, because July 4th, etc., was all an act of disobedience. It is National Compliment Your Mirror Day.
You look great today.
Or maybe when I look in the mirror, I would say this.
You look bloody awful. What are you doing here?
It's also National Fried Clam Day. And if you live in New England, don't get clam strips. Get them with the bellies. Come on. Be brave. It is National Eat Your Beans Day. That's the only sounder we could use for that. I'm sorry. It's National Chocolate Wafer Day.
Chocolate.
And you can down it with a beer because it's National Independent Beer Run Day.
Beer.
Yeah, so chocolate and beer. Homer's into both. Meanwhile, my guests today were Todd Rosenbluth, the head of research at Vetify, online at vetify.com. Kyle Brown, Chief Executive Officer at Trinity Capital, trinitycapital.com, and Jose Torres, Senior Economist at Interactive Brokers, which is online at interactivebrokers.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special one worthwhile for me each and every day. The Money Life quote of the day comes from Harry S. Truman, who said, "America was not built on fear. America was built on courage, on imagination, and an unbeatable determination to do the job at hand." Yeah, keep that in mind. Invest in America. Think about where you want to invest around the world. Enjoy the holiday. And keep money in perspective by remembering that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great holiday, a great 4th of July, a fabulous weekend. Get out and enjoy your time with your family and your friends. We'll see you here again on Money Life on Monday.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
You're never powerless as long as there's one smoldering ember on the barbecue of justice. You can still cook a mighty steak, a